Silver will catch up. It's a smaller capitalized market, but once it gets going, it just takes off. And I don't see any reason why it won't happen again here. So take a look at the long-term gold chart, the long-term silver chart. There's no question where this is going. And if you buy gold or silver for the right reasons, there's no such thing as the wrong time or the wrong price.
Fantastic.
In a recent financial discussion, RichCheckan, president and CEOs of Asset Strategies International, engaged in a conversation with Soar Financially to explore prevailing trends in the gold and silver markets. The dialogue delved into the intricate dynamics of investor behaviors in precious metals, shedding light on the impact of economic pressures on the retail sector. The gold-silver ratio is lingering near historic highs at around 88. This ratio, significantly surpassing the typical peak of 80, suggests that silver is relatively undervalued compared to gold. Once this ratio dips below 80, a rapid decline ensues as silver catches up, potentially catalyzed by gold surpassing the $2,100 mark. Checkan's analysis pointed out that silver tends to follow and outpace gold's movements, whether upside or downside. This insight fuels the anticipation of a positive trend for silver, aligning with the belief that the silver market is poised for favorable developments. In a tweet, Patrick Kareem highlighted silver's tracking of the 7-year rate of change for gold's performance versus non-USD currencies. Kareem's perspective posits that for gold and silver to enter bull markets, they must outperform various fiat currencies. Typically, this journey begins with the weakest fiats and concludes with the strongest, such as the Swiss franc and US dollar. Checkan expressing confidence in the profit potential of both gold and silver. The emphasis was mainly placed on the upside potential for silver, grounded in its historical relationship with gold. Join us as we delve into insights shared by RichCheckan. To stay updated with our latest uploads, be sure to subscribe to our channel and activate notifications. Thank you.
The way I look at it is, for me, gold is your wealth insurance. It's your portfolio's insurance policy. If you want to protect your portfolio, you buy gold. There is no substitute. Silver for me is the better option for profit in precious metals, and it's because of the relationship it has with gold. So when the gold price turns the corner and heads into a bear market, it sets the trend, is the first to do it. Silver follows and outpaces to the downside, right? So it falls deeper. And then when gold turns up, starts moving up, sets the trend, silver follows and outpaces to the upside. We saw this in the last 2 bull markets. I expect we'll see it again, and I see a lot of energy building up in silver right now. And another panelist, Omar Ayalis, just did an article for our newsletter, came out yesterday, Information Line, and basically he said that from his research and his technical analysis, we hit the bottom of this 7-year cycle in gold and silver basically last year. So silver will catch up. It's a smaller capitalized market, but once it gets going, it just takes off. And I don't see any reason why it won't happen again here. Yeah, well, gold shot up considerably today. Now, it did so early on the news, and then it receded a bit, but it didn't quite get over $2,000 an ounce. Silver had a much better day, and the dollar had a horrible day. Dollar dropped down, almost broke down through 105 on the index today. Between yesterday and today, I think it's down 160, 170 points. The point on gold, and I kind of expected it would run out of gas. We've talked about this offline. I don't think investors are in this market right now. I think investors, for the most part, are easing out of this market now because of the pain they're feeling trying to keep up with their expenses. Central banks, incredibly strong buying last year and again this year. Since October 7th, we've seen crisis buying and safe haven moves into gold. Gold shot up $160 an ounce in 2 weeks. However, I don't think without investors in this marketplace, coin and bar demand, that you are going to see sustainably higher prices over 2000. I think you need them in this market to do that. Urgency, I tend not to react to that stuff. Yes, I feel the energy building up in silver. I think it's overdue to catch up to gold. It hasn't yet.
Not just in silver, just in general.
And that gets me excited, but I'm not a big fan of chasing prices anywhere up or down. So my suggestion to people is, yes, we understand there are issues here. I think you're putting your head in the sand if you don't see them and you don't react to them. You don't have to rush and do it all today. Better to dollar cost average, figure out a plan and work your plan. The opportunity in gold and silver is not going to disappear tomorrow. Take a look. I always say, when in doubt, zoom out, right? So take a look at the long-term gold chart, the long-term silver chart. There's no question where this is going. And if you buy gold or silver for the right reasons, there's no such thing as the wrong time or the wrong price.
Fantastic.
Checkan notices a trend where wealthier customers are still drawn to gold due to favorable market conditions. However, he expresses concern about the middle class, highlighting their economic challenges and limited purchasing power in these conditions. Vince Lancy provided insights into funds' actions, shedding light on the notable shift where funds have been buying gold and selling silver. Highlighting a broader economic context, recent data from the Federal Reserve Bank of New York revealed a substantial increase in U.S. credit card debt, reaching $1.08 trillion in the third quarter of 2023. This development has sparked concerns about the implications of escalating debt levels, partly attributed to higher prices on the overall economy. Checkan emphasizes a tangible consequence of these economic challenges, noting that individuals are selling off portions of their gold and silver holdings to make ends meet. Let's get back to the interview.
I'm seeing it empirically. Yeah. So, we buy and sell with retail customers, and, higher end customers, well-heeled customers are continuing to buy and have bought all along the way. And they should, right? Prices are fantastic here. Below 2,000, they're fantastic, even above 2,000 if you ask me. So they're continuing to buy. But those are folks that don't feel the pinch of this economy right now. Their assets are down a little bit, but it's not changing their lifestyle one iota. The middle class is sucking wind. So think about it. Everything that you need is up in value for the past couple years. So the way we dealt with that 4 or 5 years ago as a consumer country is basically we cashed money out of our piggy bank, our home, refinancing. Now, if you try to refinance, you're going from 3 to 8%. Nobody's going to do that. That source of funding is cut off, okay? The second step there is to go to individual credit. It's over $1 trillion. There's a reason that's going up. People are buying what they need on their credit cards. That doesn't last forever.
20% APR?
So now we're starting to see people selling off bits, not their full position, but bits of gold and silver to make ends meet. And, we're seeing that at our firm. I've reached out to other dealers, getting confirmation that they're seeing that probably since about July on. And on top of that, what happens when demand drops? What happens to premiums?
They should drop as well.
They drop it, and guess what's happening to premiums?
No.
They're dropping.
Interesting.
So it's not just me and a couple dealers. Demand is dropping. Investors are not in this market. I think you need them in this market to go considerably higher. The market just kind of shrugged it off and said, okay, this is exactly what we expected. It seems like the market, as do I, believes Powell and the Fed are done. If they're not at the end of their rope, they're very darn close. And they're about to lose grip on the end of the rope. My big litmus test is how much debt can you service at what rates? And at 5.5%, I believe we're either at or already exceeding the defense budget in terms of servicing $33.6 trillion in debt. They can't go higher. It's just not possible. Now, he may go higher despite that, and despite us all, but I just don't think he can. And I think they're already. I said this on the panel. I believe it. I think the Fed has already broken the bank's balance sheets, and I don't think we've seen the last of what we saw in the first quarter. And I think he is breaking the back of the middle class right now. That's where I stand. The last thing they talked about, they were really strong about the resilient labor market, and you and I both know, I'm not an economist. I didn't stay at a Holiday Inn Express last night. But the bottom line is, in a recession or when things recede, the last thing to recede is the labor market. Businesses are going to try and hold on to their personnel as long as they can, hoping for the turnaround. And at some point, they're going to say, that's it, I've got to let you go. And that's when we're going to see the labor market start to feel the pressure.
Gold and silver prices are moderately lower in midday U.S. trading Monday. The safe haven metals bulls have lost momentum amid investor risk appetite that continues to improve heading into the holidays. There are solid clues the U.S. Federal Reserve is done raising interest rates amid falling inflation. December gold was last down $8.20 at $1,976. December silver was last down 0.262 at $23. What considerations and strategies might investors adopt to navigate the evolving precious metals landscape as the holiday season approaches? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.